Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. Well, ladies and gentlemen, we have Adamos Hadjiantoniou here today. It's with great pleasure that I have Adamos here. I've known Adamos since he was treasurer of the CFA Society Cyprus, and I've come to recognize him as one of the best portfolio managers and analysts here in Cyprus. Adamos actually writes a newsletter called StockOpine, where he focuses on the fundamentals and looks at high quality companies, so you can check that out on Substack. He's also a consultant for a local tech company and an eToro popular investor. He started his career at Deloitte and was also executive director at Dimitra Holdings. He has a degree in accounting and finance from London School of Economics. He is an ACA and CFA Charterholder, as I mentioned. Welcome, Adamos.
Hello, Sophocles. Thank you very much for the introduction. It's a pleasure to be here with you.
And thank you for joining us. I know you have a fantastic idea. This is actually an idea you presented in Cyprus at the event in September. And just a quick note, we are hosting an event in Rio on June 3rd and 4th. So if that's of interest to you, check out the website fatalphavalue.com. I'll put that in the notes. So what's the company?
Okay, so the company, it's Greggs. Greggs, it's an empowering investment idea because it started as a bakery back in 1939 in Newcastle, and now it's a modern food-on-the-go company. So it's like Costa Coffee, like Pret a Manger, Starbucks. So they offer sausage rolls, coffees, sandwiches, pizzas, anything for the food-on-the-go market. Greggs, effectively, how it operates, it has its own stores that they manage internally, but they also have a franchisee model where they franchise about 22% of their footprint of their estate to other operators, and they make money by cash because they sell at the store. They have a good working capital cycle, and the way they operate is food on the go, and something that I like to do when I go to the UK. But others in the UK can use their delivery apps like Uber, Just Eat, and now Deliveroo to order online. And the benefit of being in the UK, you have the loyalty app, which is a Greggs app. And now around 26% of their transactions happen through the app, which means that they have a loyal customer base. But also you can tell that, they've been there for almost 20 years. It's greatly embedded in the British culture. You see queues everywhere whenever you visit a Greggs store. So it's something that I believe it's going to be there for the next 50 years. They have a footprint of 2,739 shops. They have in petrol stations, they have in malls, in high street, everywhere you can, in industrial areas, everywhere you can think of. Most of the time it's takeaway stores, but they have also some dining options. I've seen a couple in my last visit in the UK. So they have lean operations, I would say, which makes them distinct in having strong operating margins. And by meaning strong, it's hovering around 10% operating margin. When you look at Costa Coffee, their biggest competitor in terms of number of shops, it is loss-making. So they know how to run the business, and the thing that helps them run that thing so efficiently is because they are vertically integrated. So they run the production, the manufacturing, the distribution, and they sell in their stores. Number-wise, It's 1.6 market cap billion company. It has revenues in 2025 of 2.1. It has a revenue CAGR of around 10%. As I said, it's an operating profit of around 9.7%. But okay, we're still waiting for their full FY25 results that will be published in 3rd of March.
I was in London 3 weeks ago, and I was with my daughter, and we jumped into a couple of Greg's. We had some sausage rolls the one time. I think she got a donut and some yogurt, and then the other time we tried the pizza. And I was impressed by the prices, I would say, mostly, and also I thought the quality was fine. It's not high end, but it's not bad either. So it's not bad, it's not great. It's good or good enough, I would say, especially when you're on the go. And we were being tourists in London, so we didn't want to waste our time waiting for food. And so we found Greg's to be a nice solution, a very cheap solution as well. I mean, now you jump into a coffee shop and get a bagel and a coffee, and it's, £9. Whereas three of us, we went into Greg's, me, my daughter, and Guy from the event, right? And we met up. We got into a Greg's, and I think we paid £7, and all three of us grabbed something to eat. Is there any competition from meal deals on that? Because I see like Tesco has some meal deals, and I even saw Costa Coffee has some sausage roll and medium coffee for like £3.50. I just saw this on the internet, and I was just wondering if that's a space that Greg's could find competition in, or is that something that's basically been around for quite a while, but hasn't really affected Greg's?
I believe that what Greg's is offering is that value for money that you mentioned. And so it's much easier when you are a tourist or on the go to just stand by a kiosk on a store and grab a sausage rather than entering Tesco, full queues, etc. And about that with the meal deals, I recall when I studied in the UK back in 2011 until 2014, Tesco still had the meal deals. I mean, it's not something new. So it shouldn't be considered as a threat. And what I see from Greg's, they have already introduced meal deals as well. So they give that opportunity to their customers to buy a coffee with a sausage roll and a snack at the price of £5, £6, depending if they get a large drink or not. So they are market agnostic. I mean, someone that looks for value for money and quality, because usually in Tesco you get a cold sandwich, which doesn't really taste very good. You don't get a hot coffee that you can get in Greg's. You get a cold coffee from the fridge. So it's a different offering, similar yet, but I believe it's not a big threat to Greg's future, let's say.
Yeah. Something which is also value for money and is listed as, Weatherspoons, right? The pubs. And what I noticed with them is we got something to eat in Weatherspoons pub, and I thought Greg's quality was much better than Weatherspoons, which is also another company that works with high volume. So I liked it a lot. And another thing I noticed is that the Greg's aren't everywhere yet.
Indeed. I mean, okay, in the UK, they have the largest footprint now. I mean, they exceeded Costa Coffee, but they have reached 2,700 stores as of now, and their aspiration is to get to 3,500. And they've run several exercises to see if there is cannibalization when a new store opens within a mile or after a mile next to each other. And they've seen that the cannibalization is at maximum 5%. So that tells you that there is room for expansion. Additionally, in railway stations, they don't have so many stores. in high street food halls, they don't have so many stores, and that's something that they started. They call them the bite-sized Greggs, which they don't offer the full offering. In their latest print, they announced about 3 new bite-sized Greggs. So they're trying to get where the tourists are. I mean, now one can say that the growth has come from the UK customer, but they can get more from the tourists that they are in the high streets, they are in the traveling areas. So yes, there is room. Of course, there is a cap. I mean, it can't grow forever. Mm-hmm. And this is where it comes the international expansion. That it's something that they tried in the past, I think in Belgium, if I'm not mistaken, and they failed. And I believe it's tough to enter a different market because in the UK they have the full vertical integration, and replicating that in another country, it requires a full large-scale investment without really assessing the taste and the culture of the country. So yes, I wouldn't rely too much on the international expansion, but I believe in the local expansion, there is still some tail, I mean, for long-term investors to benefit.
No, I agree with you. I think if they decided to expand internationally, I'd consider that a big negative. I mean, can you imagine Greg's coming to Cyprus to compete against Zorpas? No way.
No chance.
Yeah, no chance. No chance. Yeah. So, and I'm sure there's local champions elsewhere which Greg just cannot compete against. So I would say that would be a big negative for the story. Is there any difference between Greg's outside of London versus in London?
I've been to Norwich recently, and I just came across 2 Greg's stores. They are not so crowded, but okay, it makes sense. I mean, the population is much less, and possibly there might be other Greg's in areas that haven't been to Norwich. I mean, yeah. And looking, I mean, now at their number of stores, they have only 22 stores in central London. They have 7 in underground. So imagine there are so many underground stops. I mean, there is enough option to expand. They have 193 in roadside. So, I mean, they have also 446 in petrol stations. So there is room for expansion. I mean, in the high estate market, they are not so into it. I mean, that's why I believe there is room for growth.
And they have been expanding, and they spend quite a bit. Have they said at all when does this normalize, and what do they see as maintenance capex potentially, just so that we can come up with like what would be a normal free cash flow for this business?
So Greg's started an investment phase back in mid-2023, if I recall correctly, with their Derby, and the Derby Logistic and Manufacturing Center, as well as the Catering National Distribution Center. Those 2 are expected to be operational in mid-2026 and mid-2027, respectively. So their capex over sales in the past, if we look in 2022, it was around 6.6% of sales. So it was only 100 million. Fast forward to 2023, it was over 190. In 2024, it was over 230. And they expect to close this year with 300 million. So that's approximately 14% of sales. So it went up from almost 6.5% to 14% of sales. But that was a peak of their capex plan. So next year they expect it to fall down to 200 million. And by 2027, it will approach their normalized 150 capex over sales. In normalized scenario, their maintenance capex is about 5%. That's what they have stated. That's what they have reported across their filings. And if you add a couple of maybe 200 basis points on top of that, you get 7% capex over sales for a company that still has room for growth. So that could be huge. I mean, from 300 million capex in this year to 150, 160 in 2 years. Immediately you release 140 million for the shareholders, which possibly it's going to be delivered through dividends. Yeah, and I think that's what it's spooking the market. I mean, they're afraid whether those capex investments, they will have the necessary return on capital.
You said, it would release 140 million in a market cap of 1.6. 140 million is almost 10% of, and without taking into account that they'll have a lot more stores, so revenue will be higher. But so I guess then it comes down to, one, are they able to increase their number of stores and increase their sales while maintaining margins? I think their margin is expected to come down a little in 25. Is that right?
Yeah, what they have said, I mean, taking it from 2022, their operating margin was 10.2, and they went through that expansion phase, and in 2023 was 9.5, last year was 9.7, and they expect this year to be lower. And the thing that investors didn't really like is the guidance for next year, when management mentioned that they expect that despite improvement in cost inflation, they expect the underlying profit to remain the same. That implies that their like-for-like sales will not accelerate significantly to get that operating leverage despite the new stores. But of course that makes sense because the new stores are not counted towards the like-for-like comparison. But they also mentioned that the reason of the lower operating profit, or I mean at the similar levels, is because of that new distribution center, that new logistics centers, which will not be fully utilized. So you have fixed costs there. You don't have full capacity until you need that 3,000 stores before you get to the 3.5. So if it's not fully utilized, you have some fixed costs that will be spread across the company. That's why it will hurt, let's say, their margins in the near term. But if that aspiration of 3,500 stores works as in plan, and I mean, they laid out that plan back in 2021, then they have executed. So if they execute on that plan as well, I mean, it shouldn't be a problem because leverage will bring higher profits in the future.
Okay, so they've been preparing themselves for the larger footprint, which has brought in some additional costs, which we're now seeing, which has led to a slightly lower profits this year and next year. And that's especially spooked the markets. And I think, is there some weakness on like-for-like sales, or has that held up?
Okay, in the first half, it was 2.6, the like-for-like, and it was decelerating. But if you compare it to the overall market, they did far better than the UK market. I mean, in the same industry. So they have been winning share in a downside cycle. Then we got Q3 that they reported 1.5, which was a deceleration. And the last quarter, Q4, they got to 2.9, which was a nice acceleration. Okay, you have the festive period, etc., but it was a good acceleration. So that's something to have in mind. I mean, there is a positive sign. And also we need to understand that when they are undergoing that investment phase, I mean, the stores that they are renovating or relocating, they are not counted towards that like-for-like. But the reason of renovation or relocation is to move into a more favorable location to boost sales or to expand the footprint, let's say, for 100 square meters to 130 to accommodate more customers. So that's something that will be evident in 3 years. It will not be evident in the like-for-like. And so if we look on the actual sales growth, it was almost 7% for the year. And if in Q4, it was 7.4. it's not bad. I mean, for the UK market that there is so much consumer worries, etc. I mean, it's good to see that 7.4. And the like for like will follow. And additionally with that, with the new stores, what I've seen by looking on Greg's is that they have very high returns on cash. I mean, a new store gets to 25% return on cash by year 2. And their overall estate is above 35%. So they are investing cautiously because one can question their strategy of expanding that fast. And if to remind everyone that their previous plan was for about 150 stores per year. This year, the net new openings were 120. Next year, they also expect the same. So they are not like they are not good capital allocators. They understand whether they can put in the market those 150 or if they need to cut back and maintain a profitable operation. So yeah, I believe the story, it's good. It's not a high growth, it's not a tech company, but I believe in a growth of 5 to 6% in few years. I believe in a normalized margin that will be 200 basis points higher. So I think value will be unlocked. And if you look at their multiples, they are at the lowest level they have ever been.
Yep. What is it trading like?
It's 11.2. And if you look in their 5-year average, it was 22.7. If you look in the 4-year to exclude COVID, it was around 18. Then if you move to periods prior to COVID, I mean 2011 until 2020, it was close to 20. So there could be multiple re-rating, but that's not what I'm focusing on. I'm focusing on the earnings growth that I believe will follow and the free cash flow growth that will be released from that end of the CapEx investment cycle.
Yep. It seems that basically the market has re-rated it from a growth story to more of a mature, low growth company. And, that's fine. I think where the valuation is now, it seems to may have overdone it considering their established position. I see also, it did take a hit when they announced that trading update, January 8th, it seems. And it's been dropping since then. So I guess here what the market doesn't like is that it's mature and they don't like the capex spending, or they don't believe the capex spending. Is that what the market is missing?
I believe yes. I believe that's the issue. It's the capex, and they don't trust that capex will bring the necessary returns to justify it. Another thing that is concerning to investors and the market is all that with obesity drugs, health consciousness, and whether that affects the Greg's customer. Okay, that's of course a cause of concern, but I don't believe the Greg's customer really is that health conscious anyway. And if you get just one sausage roll for the day, it's not like you are ruining your health. I mean, you can exercise, you can do whatever you want. It's not like alcohol. I mean, alcohol is different. It has other side effects.
Are they having any problems with, what about labor costs? I'm wondering. Is that something that's creeping in?
Okay, they have around 33,000 employees, and it's about 40% of their cost base. So it's only labor. They had the issue last year with minimum wages, with increased social insurances. So that's an issue, but I haven't seen anything for that year. I mean, any new announcement if they're going to increase it again. Okay, they pass the cost to the customer through small price increases like 5p on the sausage roll, etc. But it's something that they cannot control. I mean, you have the minimum wage. On the contrary, you cannot argue that this company doesn't care about its employees. I mean, what they do is around 10% of their underlying profit is distributed to employees each and every year. I mean, I'm not afraid of that factor. And what I have seen is those self-kiosks that they have entered in 6 stores as of now. I haven't seen any more recent update, which might help to lean the operations a bit. I mean, if you have in a store 5 people, but you take that down to 3 people because you have the kiosk and the queue is moving faster, I mean, that could help them a bit. Also, they have the app that people use it to order. They don't need to go there and stand. So, yeah, I believe it's a cost. It's a major cost. It's something that they cannot avoid.
So, what do you think about management? Any comments around the executives or the board?
No. Okay, I can comment on the CEO. There was Jean Curie who joined, if I recall correctly, in 2022. She was a promotion within. It's not a new joiner or something. And she joined after they announced the 2021 long-term plan. And she has executed. So, I mean, she delivered strong like-for-like sales growth. She delivered strong profitability. She's navigating that tough period very well. The only thing that I personally don't like is that I don't see much insider trading. I mean, them buying shares to justify why the price is undervalued. That's what I would like to see. I mean, they do execute, but they are not buying shares. So the question is, are we getting something wrong? And that's why they are not buying? Or is there a different reason that we don't know, a personal reason?
Yeah, that's a good point. Why aren't they buying shares? Well, I see some interesting shareholders. I see there's Bailey Gifford in there, and so is Fundsmith. I don't know if they've had any comments on Greg's.
I haven't seen anything from Fundsmith. What I've seen, if I'm not mistaken, that Silchester, the largest investor, it's an activist investor. I'm not 100%, but this is what I recall. And I believe that could help unlock some value in the company. Then looking at Fundsmith, okay, they are long-term holders. They're usually passive. They buy great companies and they wait for the investment to bring results. So, but I haven't seen any comments from them.
Well, I think that's a good catch, because I think they crossed the threshold, I think, in November.
You mean Silchester, right?
Yeah.
That one.
Yeah. Silchester crossed the threshold. They disclosed a 5% stake, I think, back in November. So that's interesting. So it could be might not be meaningful. I guess we'll find out soon enough. Maybe we'll find out soon enough. So let's go back. Let's go to the valuation. I mean, you mentioned already it's about 11 times earnings. Maybe a little bit higher based on 26.
It's 12.6.
Okay. So 12.6 times 26 earnings. There's also dividend yield. It's over 4%, right?
Yeah, it's around 4.5%. So while you wait for that investment to work out, you still get 4.5 in your pocket. And they have been paying dividends consistently, and they have been growing them in the past 5 years, they have a CAGR of 42%. So it follows their profitability.
So how are you valuing this?
Okay. Beyond multiples, which is a sense check, what I did was a DCF analysis. And for the revenue growth, I assumed a growth of 8% for next year, coming down to 7% in 2027. And in 2028, it normalizes to 4%. And I'm using that as the terminal growth rate. Then
is this based on their store openings?
Yeah, it's based both on store openings and on inflation. I mean, looking in past figures, I have noticed that their average revenue per store increased in a CAGR of over 6%. looking in the number of stores, it has been growing around to 3 to 4% per annum. So together they can give a 9 to 10%. But given that I believe that growth has a maximum capacity, it has a cap. That's why I assume for next year to be around 8%, then come down to 7%, then 4%. And my mistake in the terminal, I used 3.5. So it's more of an inflation and a couple of renovations, new stores, etc. So it's not mainly new stores.
Okay.
Yeah.
And you're doing that on an assumption on a revenue per store basis.
Yeah.
Has there been any, now just, quick sidetrack on that, has there been any talk from management about what they're able to return from the new stores that they're opening? Do they still return similar returns, or has the returns come down from new store openings?
No, I mean, they said that it takes around 2 years to go to 25%. And they shared a slide in 2024. They didn't share a similar slide recently. And they show the 2022 cohort is around 20+%. The 2023 cohort is around 15%. Then 2021 is over 30%. So they didn't share any update, but they didn't withdraw that presentation they made. I mean, that it delivers 25% after 2 years.
Okay.
Yeah,
go ahead with your...
Based on that, I use the cash from operations margins to simplify that, which in 2022 was around 16.6, 17.2 in 2023, and it went down to 15.4 last year. For 2025, based on the interim results we had for the first half and some assumptions that I ran, I estimated it to be closer to 14%. And given their guidance of that being the same for next year, I mean the underlying profit, I assume the same for the operating cash flow margin. And then in 2027, after the first distribution center becomes almost fully operational and the second one comes into place, I adjust it by 75 basis points upward. And in 2028, before the terminal year, I take it to 15.4. That's the same as last year, 2024, and it's nowhere close to 16.6 or 17.2 we've seen in 2022 and 2023. With that assumptions, then I reduce CapEx based on their plan, which is 300 million for this year, 200 for next year, and 170 for the following years. I took a bit more cautious approach to have some margin of safety. And then I also reduce the principal lease payments from that number, which is, I believe, similar to CapEx. And because we have their existing lease payments, but given that they will open new stores, that number will grow. And I wanted to take it into account rather than taking the net debt that they have today. So it's effectively the increase. And that's another 60 to 70 million. And then I get to an annual free cash flow of 55 for next year, moving to 126 in 2027 and 160 by 2028. Then I use a terminal approach with Gordon growth model using a discount rate of 9.5 and a terminal growth of 3.5, deducting the net debt, adding the net debt, but it's negative. And I get to an equity value of 2.3, which is 23 pounds per share, around 45% higher than today's price. If I had used the average operating cash flow margin of the last 3 years in my terminal year, that would have been almost 70% upside and a share price of 26. So I believe, given the state of the company, there is enough margin of safety to protect from downside. So if we say that rule number one is not to lose money, I think we tick that box. And if everything goes well, we can make a lot of money.
Yep. So when you built that model, you based it, you looked at the historical operating cash flow versus revenue instead of modeling out the working capital separately.
Yeah.
So you did it like you just simplified it by doing it through looking at operating cash flow versus.
Yeah.
I don't think it'll make much of a difference anyway at the end of the day, because I guess you could say this company being, if one assumes that they're able to have a consistently generate profits as a, mature whatever company, then one could say, well, what is that worth? What is that worth free cash flow wise? So I guess, big brand market leader, I guess, in that segment, maybe someone would say 5% free cash flow to enterprise value. I'm just throwing some numbers out there. So if one made that assumption, then you would only need 100 million in free cash flow. And it's obviously, going forward, this will be much higher. So it seems from, that alone shows there's opportunity here.
Yeah.
I don't know if that made any sense, but
it does. And to be fair, I did a full DCF model last July, and I got to similar prices. And recently, when I updated my valuation, I said, why not going with a simplified approach and see what that gives me? And I mean, it's obvious that there is value. And at the end of the day, the profitability translates into free cash flow. You have the CapEx, which is the huge outflow. You have the principal lease payments, which is also another outflow. Working capital, it's not something extraordinary. I mean, it's normal operations. Okay, now it's the investment phase. You might add a hit there, but we already capture it by a lower operating cash flow margin compared to prior years. So that's why I believe it's not that, might not be 100% accurate, but it gives a big picture and it protects from the downside.
What changes your mind? What makes you decide that I made a mistake here and, this is not going to work?
Okay, I believe it's something that we need to wait and see, in the sense that after their two plants are fully operational, if we don't see those efficiency gains that we expect, or the number of stores growth does not follow their guidance, then obviously you know that the story has changed. But given what they have executed in the past, I somehow trust them. But if they don't execute, I mean, you don't have to be there and wait until something magic happens. I mean, you can get your dividend for the moment, the 4.5, wait for their plan to be executed, and if you are not satisfied, you can let it go. I mean, after all, investing, it's doing your own assumptions, your own expectations. You might get it right, you might get it wrong, but be honest to yourself and know when you need to let go. So,
that's a big lesson right there.
Guilty.
You got to know when to hold them. Yeah, aren't we all? So I think that wraps it up. I mean, at the end of the day, this is a pretty simple story. I mean, it's sausage rolls and other quick bites on the go. I love these stories personally, just because it's easier to think about. It's not too hard to understand. You can go to the shops and sample the food, and if you like what you see and the valuation makes sense. So we have an activist involved. Well, a potential activist involvement, which is a positive. On the negative side, we don't see any management insider buys. I think if I saw significant insider buying from management, I'd probably increase my position.
Yeah.
Just because that would be
a vote of confidence.
Yeah, a huge vote of confidence. And, they're seeing something there. Other than that, we're going to just have to wait and see and have how they execute and hope. If a recession comes, this probably gets hit.
I believe if they see a recession, they just can postpone the expansion of the second plant that will become operational in 2027. They can cut back some of their CapEx and given their low prices and the value for money, I don't believe it will significantly hurt their sales. It's not something that I see. On the contrary, I will see them cutting back expenses, cutting back capex. Possibly that won't be an issue for them. I mean, it would be, it could be, but it will not be significant. It's not like a high-tech company and everything goes wrong and it goes to zero.
When do they do most of their revenue? Is it in the morning, lunch, dinner, after hours? Because they expanded their hours, right?
Yeah, they've expanded it. Yeah, most of the time it's morning, lunch, evening is still a single-digit percentage. So it's 9.3 they have reported in the first half of 2025. That being said, it's their fastest growing part of the day, the evening, with pizzas, etc. So there is room to grow there. And it has to be noted that the evening market is much larger than the morning market. I mean, on the food and beverage market. So they are capturing that market as well. But most of them currently happens in the morning, lunch, and only single-digit percentage in the evening.
Okay. Well, Adamo, unless we have something else, I think we should just wrap it up and let people go have their coffee and sausage rolls.
From Greg's.
Hopefully from Greg's. Yes. Thank you. And guys, I'm going to put in the notes a link to his Substack, StockOpine. I think it's StockOpine.com.
Yeah.
Is that right? Yeah. And if people want to reach you, is that the best way for people to reach you through the Substack?
They can reach me through Substack, through LinkedIn, through Twitter. I don't mind.
Okay.
I mean, I'm open to answer any questions regarding Greg's.
Yeah. If you want, I can put a link to your Twitter and LinkedIn on in the notes, and also I'll be posting this on the Substack, so I could put those links there as well if that's something you'd like. And like I said, Adamos is open to hear questions about Greg's. So thank you, Adamo. Take care. Have a nice rest of the day.
Thank you very much, Sophocles.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.